Hello everyone and welcome to the next quickfire revision for Ind AS 12 income taxes. This is undoubtedly an important topic and is a tier 1 category topic for your exam perspective. Comes directly as well as along with other bigger questions in chapters like business combinations as well. Now before we proceed, we want to briefly understand why do we need a separate standard for income taxes. It is because the profits that you calculate as per your books of accounts can potentially be different from the profits that is calculated as per income tax. Now when you do financial reporting, you don't really show the profit as per income tax. You do the working, the balance sheet, the income statement, everything as per the books of accounts. And as a result, if there is any difference in those profits is attributable to differences which may be temporary or other than temporary. So this can affect the matching and accrual principles, and hence we want to introduce a new concept called as deferred tax, which can help in bridging the gap between the income tax profit and the corresponding tax and the tax which should have been recorded as per the books of accounts. Okay, so first, for proceeding further, we need a few key terms. First is, what is current tax? Current tax refers to the tax that needs to be paid as per the income tax records. On the other hand, there's something called as income tax expense, which is a tax that needs to be paid as per the books of accounts. Now, current tax plus or minus the deferred tax expense should actually give you the income tax expense. Now, what is deferred tax? Deferred tax is a tax which is calculated because you might get deductions in the current year on account of which you might have to pay more tax in the future years, which is called as taxable temporary differences, which result in you having to pay higher tax in the future years, or you might have to pay more tax in the current year because you are being disallowed a deduction, against which you will get deduction in the later years in income tax. So there is something called as a deductible temporary difference which will help you in claiming deductions in the future years. So deferred tax is actually an outcome of taxable as well as deductible temporary differences which can give rise to deferred tax. We will do the workings for deferred tax. However, we need to remember that deferred tax arises due to differences in the books of accounts and income tax which are temporary. If these differences are other than temporary, then there is no deferred tax consequence. This will be, and other than temporary differences, it will have no deferred tax consequence. So for understanding these differences, you need to remember and understand two terms. One is something called as carrying value. Carrying value is a value of a particular asset or liability in the balance sheet. Remember, Ind AS 12 focuses on the balance sheet approach, not on the income statement approach like AS 22. So it focuses on the balance sheet. So Ind AS 12 says carrying value is a value as per Ind AS which is appearing in the books of accounts, that is a balance sheet. In a similar way, there is something called as tax base. There are different interpretations of the tax base, but for an overly simplistic basis, you can consider that the tax base refers to the value of the corresponding asset or the corresponding liability as appearing in the tax balance sheet. You can consider over here that you are preparing a separate set of books for income tax and a separate set of books for your financial accounting, and the value of a particular asset or a liability as per the income tax balance sheet is considered to be the tax base for simplicity. So when we look at the differences over here can be between the carrying value and the tax base. Like for example, there's a fixed asset. On fixed asset of 100 rupees, books of accounts allows you a 20% depreciation SLM, whereas income tax allows you 50% depreciation SLM. In which case, the carrying value of the PP, that is an underlying asset, will be 80 rupees in the books of accounts. That will give a deduction of 80 rupees in the future years in the form of depreciation, impairment, etc. Whereas after the current year's depreciation, the tax base, that is the amount appearing in the tax balance sheet, will be 100 minus 50, that is 50 rupees, which means in the future years under income tax you are going to get a deduction of only 50 rupees. And hence the carrying value, which is 80, and the tax base, which is 50, which means in the books of accounts you are going to get a greater deduction of 30 rupees in the later years. That is, in income tax you are going to get a lesser deduction in the later years. That means in income tax you will have to pay more tax in the future years, and this is called as a taxable temporary difference which gives rise to a deferred tax liability. Now if you have not understood this taxable temporary differences, deductible temporary differences before, you can remember rules as we will study further to kind of in a foolproof manner calculate a deferred tax asset or liability. However, what we discussed just over here is like the rationale on why that difference of 30 rupees was taxable, because it will result in the company having to pay more tax in the later years when it will get a lower deduction of 30 rupees, and hence this will create what you call as a deferred tax liability. That is, it's going to result in the entity having to pay more tax in the future years. On the other hand, there's something called as deductible temporary difference where the entity gets a deduction in the current year under let us say the books of accounts, but it does not get a corresponding deduction under income tax. Let's have section 43B items. Let us say you have paid interest, or there is interest accrued on a loan taken from a scheduled commercial bank, in which case under the books of accounts you will record interest as and when the expense is incurred. However, under income tax, the interest is allowed as reduction only when it is paid, and as a result over here you are going to get deduction for this interest when it is paid in the future years, and hence this is a deductible temporary difference. Another example for this is like a preliminary expense. So for example, you have a 500 rupees preliminary expense. In the books of accounts, you will have preliminary expense account debit to bank, and then P&L account debit to preliminary expense for the entire 500. So there is no amount appearing in the balance sheet. Carrying value is 0. However, when we look at the tax base, in the income tax balance sheet, the entry will be preliminary expense account debit to bank 500, and then only 100 will be amortized. Section 35D. P&L account debit to preliminary expenses 100, and hence the unamortized preliminary expense will appear to be the remaining 400. For this 400, income tax will give you a deduction in the future years, and hence that will help you in reducing your tax burden in the future years. Hence it is called as a deductible temporary differences, for which you create what is called as a deferred tax asset. Remember, deferred tax is on account of temporary or timing differences, where you are probably paying lesser tax now and going to pay more tax in the future. That is deferred tax liability, or you are paying more tax now and going to pay less tax in the future. That is like a deferred tax asset. Remember, this is for temporary differences. If differences are other than temporary, let us say like donation to an unregistered trust, in books of accounts you will get a deduction. In income tax there is no deduction, in which case that will result in a permanent difference. Deferred tax over here is just deferment, that is postponement of tax, whereas if there are other than temporary differences, there is a genuine saving or an overpayment of tax, and hence you do not create any deferred tax amount. Okay, where do you take tax? Well, tax is typically taken in the profit and loss account if the underlying incomes and expenses are going in the profit and loss account, like sales, purchases, etc. It is taken in the other comprehensive income if the underlying incomes or expenses go in the other comprehensive income, like an FVOCI, fair value through other comprehensive income, FVOCI instrument, the fair value reserve will go in the other comprehensive income. Then the tax on that will also be taken in the other comprehensive income, current or deferred. And lastly, if there are certain incomes or expenses which are taken directly in the reserves, like a dividend distribution tax on dividend, then the corresponding tax will also be taken where the underlying items are going. Okay, steps in deferred tax working. This is the most important working in my understanding of this entire chapter. If you want to calculate deferred tax, then the steps that you need to follow is step number 1, calculate carrying value. Carrying value is a value as per Ind AS. Over here you have to apply all your Ind AS principles and then find the carrying value. So for example, in PP you have to consider items like depreciation, impairment under Ind AS 36, or for example in case of an intangible you have to consider amortization, or in case of let us say a financial instrument you have to kind of, if it is a financial liability, you deduct the transaction cost, then follow the effective interest method. You apply all Ind AS principles and then find the value as per Ind AS. Second, compare it as per the tax base. Tax base you visualize as if there was a separate set of books of income tax and try to pass a journal entry for the asset or liability as per the income tax records, and then figure out what should be the value of that particular asset or liability appearing in the tax balance sheet. Take the difference between the two. Whatever is the difference into the tax rate will give you the deferred tax, but the problem is identifying whether it is a deferred tax asset or liability, for which we have rather in our full classes explained the very detailed rationale over here. But for the purpose of a quick revision, if you want to remember the rules, just remember that if you first figure out what is the underlying item, is it an asset or a liability, like for example PP is an underlying asset, whereas a loan taken is an underlying liability. So you figure out whether the item is an underlying asset or a liability, like for example PP. So if the carrying value of the PP is greater than the tax base, the answer is always opposite, which means if the carrying value is greater than the tax base, the answer is opposite. So over here there will be a deferred tax liability. For an underlying asset, a liability will be created. On the other hand, if the underlying item is like a loan, which is a liability, and again the carrying value is greater than the tax base, the answer is still opposite, that is there will be a deferred tax asset. The rationale over here is, in case of PP, if the carrying value is greater than the tax base, it implies that under income tax in the future years you are going to get a lesser deduction because the tax base is lower for an asset. So you are going to get a lower deduction, and hence in the future you are going to pay more tax and hence a deferred tax liability. On the other hand, if you look at the liability and over here the carrying value is greater than the tax base, like for example there is a loan and on that loan there is an interest is payable. In books of accounts you have recorded 100 loan along with the 10% interest which is not yet paid, so you have recorded interest account debit to loan, so there is a loan appearing at 110 but the tax base is still 100. Bank account debit to loan, section 43B says interest cannot be recorded, in which case this is a deferred tax asset, because under income tax when that interest is actually paid, for the 10 rupees deduction will be obtained in books. A deduction will not be obtained when interest is paid. Your entry in the books will be loan account debit to bank, and hence it's an opposite effect, so there will be a deferred tax asset. On the other hand, if the carrying value is lower than the tax base, let's say for an item like PPE for example, where income tax gives you only a 20% depreciation but books gives you 50% depreciation, in which case the tax base is 80, carrying value is 50, in which case the difference is still 30, but now under income tax you are going to get an 80 deduction, in books you are going to get only a 50 deduction, and hence for the 30 you are going to get additional deduction in income tax, and hence you will pay lesser tax in the future years, so it's a deferred tax asset. So logic over here is, if the carrying value is lower than the tax base, your answer is in the same direction, like a underlying asset will create a deferred tax asset. In a similar way for a liability, if your carrying value is lower than the tax base, then again the answer is in the same direction, that is an underlying liability will create a deferred tax liability. If the carrying value is equal to the tax base, there is no difference and hence there is no deferred tax. So long story short, step number 1, calculate carrying value after applying all Ind AS principles. Step number 2, calculate tax base. Usually the institute will guide you on the income tax treatment for a particular item. Step number 3, the treatment of the difference between the two, that is the difference. And step number 4, you try to calculate the deferred tax. The difference into the tax rate will be the deferred tax, and deferred tax, whether it is an asset or a liability, you see whether it is an underlying asset like a PPE, and then you figure out whether the carrying value is greater or lower than the tax base. If carrying value is greater, the answer is opposite, so an asset will create a liability. If the carrying value is lower, then the answer is in the same direction, so an underlying asset like PP will also create a deferred tax asset. For the liability also the rules are the same. Basically, if the carrying value is greater than the tax base, answer is opposite. Carrying value is less than the tax base, answer is in the same direction. You can just practice this, or you can remember other rules which you are more comfortable with. Offsetting principles. In the balance sheet, can you offset deferred tax asset and liabilities? Yes, you can offset and show them net, provided they are arising out of the same income tax loss, and they can be offsetted. Like a deferred tax asset on preliminary expenses can be offsetted by a deferred tax liability created due to depreciation on PP, provided both of them are arising under the same Indian income tax law. However, if one of them is arising under the Indian income tax law and the other is under the US tax law for a multinational organization, then you cannot offset. You will have to then show both of them separately. Acha, while we did the steps for calculating deferred tax, we said that you should take the difference into the tax rate. But how do you figure out the tax rate? Well, tax rate is, for current tax, the tax rate of the relevant assessment year. However, for deferred tax, the standard over here says that the tax rate should be the future tax rate, because the deductions will be obtained in the future year, or you will have to pay tax in the future years, and hence ideally you should take the future tax rates. However, you as an entity cannot predict what the government will give as a tax rate in the future, and hence estimates are not permitted. In fact, you are allowed to take tax rates which have been enacted or substantively enacted till the balance sheet date. For example, a budget is given for the next year where tax rates are given or official notifications are given by the government, then you can take those rates which have been either enacted or substantively enacted till the balance sheet date for the purpose of deferred tax calculation. Point number 1. Point number 2, is it possible that there is a change in tax? Yes. If there is a change in tax, then you will have to remeasure the existing deferred tax assets or liabilities which are there in your balance sheet based on the revised tax rate, and the difference, if any, will be taken to the P&L if those underlying assets are going into the P&L, or it can be taken into OCI if it is on items like revaluation or fair value reserve which are going into the OCI. Third, which is not as important, but the rate of deferred tax depends on how you intend to utilize the assets. So for example, if there's a PP which you intend to sell, in which case the rate at which deferred tax should be calculated is the capital gains tax rate. However, if there's a PP which you intend to use, then the rate at which deferred tax should be calculated should be based on PGBP, that is a general marginal tax rate. Okay, so this is all the data which is given about tax rates. Then there is, should you always create a deferred tax asset or a deferred tax liability? Well, for deferred tax liability, the standard says yes, because when you create a deferred tax liability, typically expense is debited. Deferred tax expense, account debit which goes in the P&L to deferred tax liability. So if a deferred tax liability is to be created, we happily create it because it will create an expense. However, if a deferred tax asset is to be created, it is like a contingent asset. So you debit the deferred tax asset and the P&L gets created. For example, one of the classic cases where deferred tax asset is created is carry forward losses. So in case of carry forward losses, what happens is, let us say books of accounts and income tax principles are same. In which case, in books of accounts, there is, let's say, a sales of 700 and expense of 1000, which means there's a profit of 300. The profit of 300 will be recorded in the current year itself. However, under income tax, if there's a sales of 700 and cost of 1000, then there's a loss of 300, which will be carried forward to be offsetted in the future years, and as a result there will be a difference due to carry forward loss. Remember, carry forward loss when offsetted in the future will help you in paying lesser tax in the future years. So you don't really need to apply those rules, what is carrying value, what is tax base. Deferred tax asset will your carry forward loss will always create a deferred tax asset because it will provide you deduction in the future years and help you pay lesser tax in the future years. So carry forward loss will always give you a deferred tax asset. So if there's a carry forward loss, should you always create a deferred tax asset? Well, the standard says it is possible that you will never be able to utilize those carry forward loss, and hence to show the deferred tax asset does not make sense. So how will you calculate the deferred tax asset? Well, you calculate deferred tax asset using the regular steps. Let's say 300 crores into 30%, 90 crores. Should a deferred tax asset be created? Well, the standard says if the entity has sufficient benefits against which it can utilize these deductions or carry forward losses, then you can create a deferred tax asset. Otherwise, no. So how will you figure out whether the entity has sufficient benefits or not? First, they say that if the entity has sufficient taxable temporary differences whose reversal pattern matches the reversal pattern of the deductible temporary differences. Like for example, there's a taxable temporary difference of 9,000 which will reverse 3,000 in year 1, 3,000 in year 2, 3,000 in year 3. And there's a corresponding deductible temporary difference of 4,000 which will reverse over the remaining 4 years, 1,000 in year 1, 1,000 in year 2, 1,000 in year 3, 1,000 in year 4. Then for the deferred tax asset, we can say that the deferred tax asset is on a deductible temporary difference of 4,000. Out of this 4,000, the 1,000 of the first, second and third year matches with the reversal pattern of the taxable temporary difference, and hence on that 3,000 a deferred tax asset can be created. But for the last 1,000 there is no corresponding taxable temporary differences that reverse. That is one source against which you can utilize. Second is the most important thing, which in my opinion is the existence of sufficient taxable profits. So if there are sufficient taxable profits against which you can utilize the deductions or the carry forward losses, you can create a deferred tax asset. Like for a company, there's carry forward loss, but it can potentially lapse even if there's no carry forward loss and there are expenses which you expect to get deduction in the future years. That is, you create a deferred tax asset if you expect to pay lesser tax because of obtaining those deduction in the future years. If you don't foresee a profit in your company, you are in a downward trajectory, you don't even foresee a profit, in which case how can you tell the world that this is going to help you in reducing your tax outflow? You are not going to pay any tax in the first place. So there has to be sufficient taxable profits against which these deductible temporary differences can be utilized. Second and third is in case you can implement certain tax planning strategies or opportunities where you can create profits against which these deductions can be utilized. Like you can change the method of accounting of interest, for example, from a cash system of accounting to accrual system of accounting. Thereby you can utilize that interest to interest income to offset the losses or expenses which may become due in the next 1 or 2 years. So we have discussed all of this over here. I'm just giving you a preliminary overview of these concepts. So you can create a deferred tax asset only if the entity has sufficient benefits against which you can utilize those deductions or benefits, and these sufficient benefits can be calculated as the total of taxable temporary differences whose reversal pattern matches with the reversal pattern of the deductible temporary differences, existence of sufficient taxable profits, and the tax planning strategies which can be used. So the maximum deferred tax asset that can be created is the total of these items into the relevant tax rate. Now on business combination, deferred tax, let us say on a business combination, we have discussed this when we did even the chapter on business combination. The principles remain the same. Like in a business combination, you take over the net assets. Like every other item, for net assets, you compare the carrying value with the tax base. If the carrying value is greater for net assets, which are basically assets, your answer is opposite, that is a deferred tax liability. Whereas if the carrying value is lesser, the answer is in the same direction and hence a deferred tax asset. Sometimes at the stage of business combination, it is possible that a deferred tax asset may be on the carry forward loss of the selling company. The selling company may not have created a deferred tax asset because it did not believe that it will earn sufficient profits. However, on acquisition by the parent, if it now believes that sufficient profits will be earned, then a deferred tax asset can be created for the carry forward losses even at the stage of business combination or even at a later date. Okay, a few important points over here is that what should you take as the carrying value for these business combination questions? The carrying value will be the fair value. That is the value at which you record assets and liabilities as per Ind AS, whereas the tax base will usually be the old carrying value. However, if a separate tax base is given, you obviously take that. Second, the DT or DTL will be calculated based on the tax rate applicable to the subsidiary. Remember, these are assets or liabilities of the subsidiary and will be assessed to income tax based on the PAN of the subsidiary, and hence the relevant tax rate will be the tax rate of the subsidiary. Third, should you create a deferred tax on goodwill? Well, the Ind AS provides an exemption from creating deferred tax on goodwill, more so because most of the times goodwill is not tax deductible, and even if it is, usually over here, if you try to create a deferred tax on goodwill, it will create a circular reference where deferred tax will change, so goodwill will change, so again deferred tax will change, and hence there is a circular reference, and hence for simplicity they have allowed you not to create any deferred tax liability on goodwill. Again, for a business combination, remember you're solving an FR paper and not a tax paper. A lot of students think through in a lot of detail that how is this tax deductible, how is this tax deductible. Remember, you're solving an FR paper, and hence unless given otherwise, all the differences are assumed to be temporary unless given otherwise. Okay, now there are also some other exceptions to the creation of DTL, especially for holding subsidiary or parent and or investor and associate relationships. Ideally, you should always create a deferred tax liability, except if it is on goodwill, in which case you will not create a deferred tax liability. Or let us say you control the timing of payment of tax. Usually you do not control. Liability is something where you have no realistic alternative but to pay. However, in case of a holding subsidiary relationship, let us say over here the subsidiary company is making a profit. Now let us say in the books of the holding company, the tax will be paid when the dividend is distributed. However, whether the dividend will be distributed or dividend will not be distributed, that is controlled by the parent company. And if the parent company does not expect or does not want the subsidiary to distribute dividend in the foreseeable future, there is no point creating a deferred tax liability, because it might happen that the subsidiary company over here has made a profit. So on a 1,000 rupee investment, during the year a profit of 100 rupees has been made, and hence the carrying value of net assets that get consolidated is 1100. Now, if this 100 gets distributed, then the parent will have to pay tax on that. However, the parent believes that the subsidiary will keep those 100 for the purpose of its future reinvestment, in which case if the 100 is not distributed, then the parent does not need to pay tax till the time it is distributed, and parent can control that timing. And hence there is an exception provided where it is told that if dividend distribution is within the entity's control, which is the case in holding subsidiary cases, and the entity does not expect or does not order the subsidiary to pay dividend in the foreseeable future, then there is no need to create deferred tax. This is available only for parent subsidiary cases, not for investor and associate cases, because an associate, an investor can have a significant influence but not control. So I might hold a 25% stake, but if someone else is holding a 75% stake and that person decides that the associate has to pay the dividend, well, we are going to receive the dividend, and hence we cannot control the timing, in which case if there's a difference between the carrying value of the investment as per the equity method and the value as per income tax, you should create a deferred tax liability. We have explained the rationale over here as well on the next page, and then there is a special case which creates a lot of problem for the students on deferred tax and share-based payments. So when we look at deferred tax along with share-based payments, there's a specific guidance given, and hence we have to follow that guidance only. So ideally, an SBP reserve is calculated based on the fair value as on the grant date as per Ind AS 102. However, income tax in practice gives you deduction at the time of exercise. To the employer, it gives a deduction at the time of exercise based on the intrinsic value, that is the difference between the market price and the exercise price on the date of exercise. So the base on which tax is to be levied or deduction is to be given is completely different in the books of accounts as compared to income tax. So the standard over here says that let the carrying value as per Ind AS be nil. Ideally, the carrying value as per Ind AS will be the balance which is appearing in the SBP reserve. However, as per income tax, that number is useless because that is the fair value as on the grant date. Income tax does not give you deduction based on the fair value as on the grant date, and hence it has been specifically instructed to take the carrying value for these SBP items to be nil. Then what is the tax base? Now, tax base should be based on the balance sheet value of these items. However, we will know about the actual deduction that we are going to obtain when the exercise happens. So the standard over here gives specific guidance and says that we don't know. Let's say it's a 3-year vesting period after which exercise can happen. You are at the end of the first year. You don't know at what value, what will be the value of the share when the exercise happens. You know the exercise price is 50, but if the market price is, let us say, 90, then 40 rupees is the excess amount. If the market price is 190, then 140 is the excess amount. So the tax base is to be calculated as the difference between the market price at the end of the first year and the exercise price. So the intrinsic value at the end of the first year. So we assume that if things continue to remain the same, this is the amount that you will get as deduction under income tax. However, for this, the employee has to stay for 3 years, and as a result, whatever is the intrinsic value in the first year, you will take intrinsic value into 1/3. That is to be taken as a base. In the second year, you will take the intrinsic value into 2/3, and the third year into 3/3, and so on. So over here, this will give you the tax base. Now, ideally, you calculate the difference and then apply those rules. In this case, you don't have to apply the rules. You have to fundamentally say that this is something for which income tax is going to give you a deduction in the future years. You are going to get deduction not in year 1, not in year 2, not in year 3, but in the year when the exercise happens. And as a result, this is something for which income tax is going to give you deduction in the future years, and hence this will create a deferred tax asset. So you don't apply the rule of carrying value greater than tax base, less than tax base. That rule is not applicable over here. Typically, that rule applies only for assets and liabilities. This is more of a reserve item, and hence special rules in any case will be applicable. So step number 1 is carrying value as per Ind AS is to be taken as nil. Step number 2, tax base under income tax will be based on the intrinsic value as on the date of exercise, prorated. Step number 3, over here, the difference will create a deductible temporary difference, and hence the difference into the tax rate will give you a deferred tax asset. Are we clear with this? So this gives you a fairly detailed, I would say, overview about Ind AS 12. I hope this video has been helpful. Please do like, share and subscribe the video if you have liked the same. Let me know in the comments if there is something else that you're looking for where we can try to help. Till then, wish you all the very best. Good luck, goodbye, and see you soon.